Hello everyone, this is Andrew McNair from SWAN Capital with our December 2023 SWAN report. In this month's video, we're going to discuss the recent headlines that influence the financial markets. But I want to provide you some perspective on what all of this market data, what all this information from the economic talking heads actually means for you and your portfolio, what it means for you and your retirement. But as always, please stay tuned at the end of this video for a required disclosure statement. Now, at SWAN Capital, our firm, our market outlook is cautious because of world conflicts and higher consumer credit coupled with higher interest rates. But luckily, Christmas came early this year. For investors, that means. Colloquially, we know it as the Santa Claus rally. The market experienced an upward bounce in the latter half of November. On the equity side, we saw fantastic gains. The S&P 500 and the NASDAQ saw their best monthly gains since July of 2020. We saw an 8.9% and a 10.7% return respective. Over on the bonds side, U.S. Treasury yields continued to drop, and the bond market had its best monthly gain in nearly 40 years. The personal consumption expenditures, the PCE index, rose a mere 0.2% in October, for a year-over-year increase of 3.5%. Now, sure, it's still above the Fed's 2% target, but it's the lowest the PCE has gone in 2.5 years. And that latest personal consumption expenditure data was even lower, running at 2.5% over the past 6 months. This PCE number means that Americans aren't spending as much as they previously were, which is concerning. Except on Black Friday, we were all shopping in full force, shelling out billions of dollars on Black Friday and Cyber Monday. But the combo of waning income growth, high interest rates, increasing prices, and now the student loan payments that are starting back has started to eat into folks' income, savings, and it's starting to cause an effect, and people are having to cut back. It's a departure from earlier in the year, where we saw GDP, gross domestic product, was revised upward of 5.2% after a second reading last month. However, there is something that is still not being cut back on: government spending. I'm not going to catalog how much is being spent, who is receiving the money, or what it's actually earmarked for, because it would all just anger all of us. No matter what aisle you're on, we're all angry with government spending right now. What I'll say, though, is that the government spending is also unsustainable, and it's at its current levels. We owe over $33 trillion overall and running a $2 trillion annual deficit. This interest payment, as interest rates are inclined, not only affecting your family, are going to start affecting the federal government's budget. There will be increased pressure to cut government spending and reduce our debt. But the easiest thing to go towards is raising taxes. To sum up, we saw a big number for third quarter GDP, but we cannot keep this up forever, and the economy may be headed for some trouble ahead. On the housing market, things are tough for home sellers. Personally, the properties I still have for sale are coming to a screeching halt. Home sales fell in October to a 13-year low, really pummeled by high home prices, interest rates. Sales of existing homes, which make up a big chunk of the housing market, decreased by 4%, the lowest since August of 2010. That's a scary year if you think about it. That was according to the National Association of Realtors. But we could be rounding the bend. Mortgage rates have started to pull back somewhat and spurred a small burst of applications from buyers in early November. However, it may be a good time to downsize and take advantage of this stalling real estate market. If you have a home that it's too big for you, it's the time to sell it and downsize and buy something in cash. All signs are pointing to the Federal Reserve keeping interest rates where they are. At their last meeting of 2023, comments from several Fed officials seem to be confirming they're done raising interest rates. Board member Christopher Waller said, "I'm increasingly confident that policy is currently well-positioned to show the economy and get inflation back to 2%. Waller even opened the door just a crack to possible rate hikes in early 2024. He said that if inflation continued to moderate over the next 3 to 6 months, we could start lowering the policy rate just because inflation is lower. And in his comments, Fed Chair Jerome Powell said that interest rates were now well into restrictive territory. And that's language that we want to see. And again, when we start seeing home prices start ticking down, if we start seeing the market continue to slow as it is, I think interest rates will stall, which will be great to see. But just the hedges bets, Powell also said the Fed would raise rates again if dictated by data. Is the Fed actually going to be able to pull off a soft landing with the economy? It's looking more and more promising. Personal spending rose 0.2% in September, and personal incomes kept pace too. Housing permits came in above expectation for the month of October, so that's really promising. Weekly jobless claims ticked down. However, continuing claims jumped to 1.93 million, their highest level in 2 years. That's it for this month's SWAN report. I want to thank you for listening. And always remember that this is not personal financial advice, but if you need personal recommendations for your financial plan, your retirement, give us a call at 850-380-9558 or our global number at 1-800-848-8768, and we'd be happy to talk with you about your retirement soon.